All right, so in this video, I'm going to talk a little bit about the main functions of the financial manager. So the main goal of the financial manager was maximizing long-term shareholder wealth, and I discussed that in a prior video. In this case, we're talking about the main functions of the financial manager. So the main functions can basically broadly be grouped into three different categories. So the three categories we have are planning and forecasting, use of assets, and financing of assets. So pretty much everything that a main financial manager is going to be doing in a company is going to fit in one of those three categories. So if you think about planning and forecasting, this is going to be where you're going to include things like financial statement analysis. So looking at financial ratios and trends, sources and uses of funds, you're projecting financial statements. Those are called pro forma financial statements. So that's the planning and the forecasting. So the planning, we're analyzing where we are. We are trying to figure out where we need to be. We are making projections, trying to fit all that together in terms of where are we, where do we need to be, what needs to happen along that path, and so forth. Then we get to use of assets. So for the use of assets, well, if you think about the types of assets, we've got current assets, we've got net fixed assets, we have various other kinds of assets too. So if we're looking at the use of assets, that's going to involve things like, so for current assets, how much inventory should we have and why? How much cash should we have and why? How should we handle receivables? Things like that. So trying to make sure we're utilizing the assets of the firm appropriately. And a lot of the different kinds of assets we have are beneficial in various ways, but they also potentially have downsides if they are inefficient and unproductive. So for instance, generally speaking, we don't want to have massive amounts of cash relative to the size of the business just sitting in a bank account somewhere, because we generally aren't getting much return on that. So the question is, well, how much cash should we have, and how much do we need, and how much is too much? So that's those are some important kind of considerations there. But also things like net fixed assets. So how do I evaluate whether I should buy a piece of equipment A or a piece of equipment B, or maybe it's one type of fleet of delivery trucks or another type of delivery trucks? Basically, how do I assess that and make sure that I'm making wise choices with how I'm using those assets and making those purchase decisions, things like that. And of course, other assets could be all kinds of other things too. But trying to make sure that we're utilizing those assets effectively, that we're purchasing assets that are beneficial, and so on. Then we get to financing of assets. How did we pay for all this stuff? Did we use debt? Did we use preferred stock? Did we use common equity? How are we paying for these different kinds of assets? And so different companies will use different combinations of financing to pay for these things. So the main functions of the financial manager generally fit within one of these three categories: planning and forecasting, use of assets, or financing of assets. Sometimes you might see some slightly different names for these, but basically the idea is pretty much the same. And we can actually take that a little step further, and we can actually look at sort of a breakdown of these different categories. So if I have kind of corporate finance here, I got planning and forecasting, use of assets, and financing of assets. We can kind of fit a lot of other things that would fit within finance under these, or corporate finance within these main headings. So if I'm looking at planning and forecasting, we got the financial statement analysis, so sources and uses of funds, financial ratios, think liquidity, debt management, asset management, profitability. DuPont is basically about based off of debt management, asset management, and profitability. And you could even throw in some other ratios that might be industry specific and things like that as well. Then you get over the pro forma statements. So we are actually projecting out financial statements and trying to figure out how much money we're going to need to support the growth that we're projecting. How much could we grow without needing more financing? So the sustainable growth. So all of this kind of fits within that planning and forecasting. And if you concluded that you had problems with various ratios, in other words, maybe your debt ratio is too high, when it comes over to your projections, well, we probably ought to be making some decisions that would address those concerns. And so that's why, these are kind of interconnected here. Where we are currently affects what we can project in terms of what is perhaps possible. Now, if I get over to use of assets, current assets, we have things like inventory management, cash management, receivables management, all the different current assets. I didn't put every last category on here. But basically, the key idea with the current assets is that we sort of have a love-hate relationship with current assets. We know that we need them, but they generally aren't particularly beneficial in the sense of making money. And to see that, we need to kind of clarify something here. Here's the important distinction. We make money by selling inventory or a service or what have you. We don't make money so much by having it. Now, you might think, well, what kind of distinction is that? Well, it's an important one to make. And that is basically, it's the act of selling that inventory that makes us the money. Having it all sitting in a warehouse somewhere does not make us a bunch of money. Now, Do I need inventory sitting in a warehouse somewhere to have inventory on hand to sell to somebody? Well, that may be true, right? So there's sort of a tension here of I know I need a certain amount of inventory, but I also know that if I have a lot more just sitting around in like a warehouse, well, then that's not really helpful. So there's sort of a tension there. And the same thing goes for the receivables management. If I sell an account, I'm probably going to sell more. I'm going to make more money in that sense. But then I'm also opening up that possibility that somebody's not going to pay me. And that means I didn't get paid for that. So I sell more when I sell an account, but then somebody doesn't pay me and people pay me later. So I have to kind of figure out what's the best possible choice here. So that's the challenge that you have with looking at current assets and trying to figure out the appropriate use of assets. Now, for net fixed assets, you have things like capital budgeting. So should I buy a piece of equipment A or should I buy a piece of equipment B? How do I make that decision? How do I analyze that properly? And so that's going to be something that you would look at for the net fixed assets and the capital budgeting and so forth. You also get into real options analysis. And that is where you actually have the ability as a company, in many cases, to change what you're doing, and then that has an impact on your business. So for instance, maybe I shut down a production line, I make some changes to it, and then I reopen it to produce a slightly different kind of product. And that changes basically maybe how my business responds to a recession, for instance. So I could do that. And if that's a choice, how much is that flexibility, the ability to do that, how much is that worth to me? And that's something that we'd want to evaluate. And then, of course, you get to all kinds of other assets. You basically just want to make sure you're using those efficiently and effectively and that they actually are productive and beneficial and so forth. Now, you can also look over at the financing of assets. So if you think about financing of assets, that invokes kind of a couple of related topics. Among them would be capital structure. Capital structure is just a fancy way of saying the mixture of debt, common equity, and preferred that we've used to pay for all these assets we've got. So it's just what mixture. Some businesses use a lot more debt. Some businesses use very little debt and mostly equity. So what mixture are we using? We also could therefore look at the cost of that capital. So I don't want to use a combination of capital that is leading to a very high cost. So I want to make sure that I'm using a mixture of financing that is a low cost. So I want to be thoughtful about that when I'm trying to figure out how to pay for these assets. Now, within these categories, I've got the financing assets. I've got basically debt, preferred, and common equity. Those are pretty much the three big categories we got here: debt, preferred, and common equity. Now, within debt, you've got various types of current liabilities. So it could be short-term bank loans, things like that, commercial paper, that kind of thing. You could also have long-term debt. Think bonds and notes and things like that. And that invokes things like bond valuation and learning about how bonds are valued and what affects the value of bonds and so forth. Now, I have a little connection there between long-term debt and net fixed assets. If you lease a long-term asset, what you're kind of doing is, on the one hand, getting a net fixed asset, but on the other hand, you're also creating a debt obligation through that lease. So if you're leasing a net fixed asset, you've got the net fixed asset piece, but you're also tying that to a specific, basically, debt. It's an obligation, and it's a long-term obligation. So a lease kind of sort of connects those two areas a bit. Now, if you go over to common equity, well, we got common stock. So if I issue shares, and within common stock, you'd have paid in capital in excess of par, that kind of thing. Then you're going to have retained earnings. And so if the company makes money and they have a profit, they don't send it all back to the shareholders who technically own the company. Then that's retained earnings. So I could fund the company through retaining earnings. So I make money and keep it as a company and reinvest it. So that's shareholder investment, basically. But that also ties in with dividend policy. So if I make a profit, net income, and I retain it, then I'm not paying it out. On the other hand, if I do pay it out, then I'm not retaining it. So my decision to retain or pay dividend is interconnected with the amount of asset or the amount of equity that we'd have to pay for those assets, right? Now, if you think about the common equity, within that basically means if I'm thinking about common equity and these cash flows, things like that, that starts to invoke stock valuation and think about, well, what affects the value of the stock. Now, I have a couple categories here that are sort of in between the debt and the common equity. So I have convertible bonds or notes and warrants. So for convertible bonds or notes, those are long-term debt instruments that can be converted into a specified number of shares. So this kind of creates a hybrid where it's partially debt, but it also has that conversion provision that means it could turn into equity or be turned into equity, and therefore it's got properties of both debt and equity in some respects. Or if you get a little bit more technical, it's essentially you've got a debt instrument, but you also have kind of an option involved here. And warrants are sometimes essentially like long-term call options that are attached to debt. And basically, they give that debt holder the option to buy a certain number of shares if desired. And so that's separate from a convertible bond. Convertible bond, you essentially hand in the bond and you get shares in exchange. For a warrant, you keep your bond, but with that warrant, you could buy a specified number of shares at a fixed price, which if the stock price goes up a lot, starts to look attractive. So for those types of securities, if you've got warrants or convertible bonds or notes, there's kind of some equity pieces there and some debt pieces that are involved in creating that instrument. Okay, so hopefully this broad overview of corporate finance, those three main areas, has been helpful. Thank you so much for watching and have a great day.